And with that, Herwig, I think it's time to move into our main topic. What are we looking at today?
Well, as we discussed earlier, we're looking at collateralized lending with digital assets. It's being brought into focus specifically because of a recent article that we caught on Cointelegraph, which discusses the hack that we talked about a little while ago, a few episodes ago, on LendF, which is the DeFi, the decentralized finance lending protocol that was, of course, hacked, exploited via an exploit several weeks ago. So as we reported on episode 40, the lending platform ultimately managed to recover roughly 23 million of the 25 million that was locked in the form of crypto in a smart contract tied to the LendF protocol. LendF managed to do this. Actually, they managed to recover the funds by negotiating with the hacker after they were able to find a traceable IP related to the hack. So had the hacker not made this amateur mistake, they might have gotten away entirely. But indeed, they managed to recover at least a good chunk, a majority of the funds. But the article simply spotlights, a discussion that we ought to be having around DeFi, as the Cointelegraph author Andrew Rosso puts it. So ultimately, the article calls for a focus on security, user trust, and that it shouldn't be rushed out code in test cases like this. And interestingly, also singles out Ethereum as non-scalable and that lending protocols are now seeking alternative solutions. DeFi and lending protocols like MakerDAO, Compound, and LendF have been growing in 2019 and in 2020 in surging demand, especially with Andreessen Horowitz backing several of them. And we figured now on the show is about time we covered the subject, especially with this rise of collateralized lending products.
You brought up some really interesting topics there, Herwig. I mean, I agree that this topic has long deserved an episode, and we may actually warrant additional content as we explore more specific facets of what decentralized finance means and how it can be applied. I think we're seeing many of these protocols following what might be the startup mantra of, quote, move fast and break things, right? Which rationalizes the idea behind focusing on growth and scale while figuring out how to put out the fires later. And I think that some firms are seeing firsthand that reckless development and short-term tunnel vision in the financial industry can have devastating consequences if it's not properly managed. That being said, decentralized finance mechanisms are revolutionizing the way that we handle traditional finance transactions and processes. So, Herwig, if you could do all of our listeners a favor and explain the growth of this movement and how collateralized lending works, I think that would be really helpful.
I will try and do my best, Kyle. So first, I think it's important to walk through why collateralized lending is very interesting from an investor perspective. So, the ICO fallout left a lot of people holding crypto. And the thing about crypto investors is they almost never actually take money back out. I mean, convert their crypto into cold hard cash. This meant that now a lot of people were holding onto crypto, looking for projects to invest in, realizing that ICOs no longer offer decent opportunities to invest in. And this is what's really important about the tokenization movement, all right? By bringing assets on chain, you can start making instant settlements, as we've covered using atomic swaps in last week's episode. So I think it's important to see how that actually works in a very simple example. So let's use cash. If I want to go make a purchase using physical cold hard cash, I need to go take my cash and go to a store to then trade that for a good. If we got a little smarter, maybe I decided to get a debit card, which basically is me saying that I'm going to use a third-party representation of my cold hard cash, which is now sitting with that third party, aka the bank. But still, I'm only limited to stores that can accept my debit card or really my financial institution's certification that I have the money. So let's move up and go with investments. When you do an investment today, you're typically going to wire money. So instead of giving cold hard cash in large quantities or using a debit card, you'll do a direct transfer with your institution. In this case, the wire may go directly to your investment and that depends on, the reciprocating financial institution to authorize that investment came through from the wire. And similarly, with a brokerage account, the third-party broker-dealer receives your wire and also signs off that they now have custody of your money. Now we can instruct that broker, of course, to place the money into all kinds of investments on the stock market and other investment products. And of course, in return, or at least in principle, we would get stock certificates. But of course, we know that's not actually happening. But in principle, we are getting our interest in the investment products via stock certificates. And the reason I'm bringing up this example is that when you take your cold hard cash, you can't really just convert it via into a stock certificate. You have to go through this whole process. Whereas if I were to take my cold hard cash and convert it into a stable coin, that stable coin can now let you digitally purchase or invest in anything programmatically and instantly that is also digital. So imagine that for a second. Why physically walk to that store? Why rely on a third-party bank or broker? Why wouldn't you just take your money and make it digital and then start instantly transacting? It's naturally the future, at least we believe. And for those of us who have been early adopters, at least in the blockchain space, enough to have created some kind of wealth on chain in the form of cryptocurrencies or stablecoins or even security tokens, they all have that power now to instantly transact, which I would say is pretty darn cool. So all it takes is physical cash and finding a middleman to give you a digital representation in some sort of digital asset, and now you have on-chain capital. But let's go back now to our ICO fallout in 2019. Some of our crypto community friends looked for additional ways to grow their digital portfolio. After all, your crypto doesn't just need to sit in an account somewhere anymore. It can be put to work just like a bank might offer with a savings account or a broker might offer with an investment product. So many of these individuals who own stable coins and crypto wealth looked for ways to put that to work, and collateralized loans became a new industry as a result. So using my example of the company of the week with Cash enables me to get a stable coin backed by gold and will reflect the price of gold in the gold markets, of course. So let's say for simplicity's sake that we buy $100 worth of CGT Cash Gold tokens that we now have in a wallet. So great, we can leave it there and let the price of gold go up, and maybe I convert it back into US dollars when the price is right and I want to harvest my investment. Or maybe in this case, on-chain custodian would enable us to make 10% on our CGT tokens while they're just sitting in the wallet. How does that work? There could be several security tokens representing real-world assets that offer an immediate swap back to CGT gold tokens at any time, which would allow us to get our security tokens instantly back to gold, making this an investment that we can kind of transfer into something else. On-chain custodian could also offer to custody the gold while they lend out against it, making the CGT tokens collateral. So in this way, if on-chain custodian was able to lend, say, at a 15%, the cold hard cash, we can get 10% for the CGT tokens, or $10 on our $100, while they keep $5 for themselves for managing the lending side of things. So if gold now also doubled in price while we were lending, that means we would get both equity yield from the gold rising and lending yield from our token collateral. All to say, at least, that this is much better than your cash just being cash in your pocket linked to the value of the US dollar. So now MakerDAO and Compound and others have set up various lending protocols. MakerDAO, for example, enables you to use their native stablecoin currency DAI as a token to peg cryptos to, and then start trading or borrowing on them via smart contracts and atomic swaps. As the underlying cryptos gain value, or the DAI currency gains value, which is staked and consumed by the MakerDAO protocol, so does the investor or custody agent. In this way, actually, in some cases, you might be able to find interest-free loans because the expectation is the value of the underlying crypto will go up. And with enough collateral, or even not enough collateral is put into place, it makes lenders start to get very interested at crypto assets and the potential possibilities of collateralized lending. I think there's something like roughly 1 billion in total that's been put through the various protocols. And since all of this is done on chain, of course, the term decentralized finance emerged as a potential solution to creating an alternative and better financial infrastructure than what we have today. Or what, if you ask me, my perspective, crypto 2.0. Since ICOs didn't hold and Bitcoin hasn't reached true adoption, this seems like a next value proposition for crypto. Kyle, I just blabbered a whole lot about DeFi and collateralized lending with digital assets. Tell me, what are your thoughts on this? How do you see this mixing with security tokens?
It's a nice breakdown. It seems like the collateralized lending space has supremely benefited from having the loan's full lifecycle originated on chain, as it allows the full contract between both parties to be tracked and executed programmatically via smart contracts. The benefits there, obviously, we've detailed them before, even in my company's week earlier, but we're talking about efficiencies, we're talking about reducing friction, we're talking about making it cheaper and faster. I like the idea of lending contracts on current holdings. It's not a whole lot different than traditional brokerages today that will actually execute derivative contracts on your current stock holdings, except for in the traditional method, they keep the entire profit. So you actually have no idea they're doing it. You don't get any exposure to it. And so it's honestly kind of a asymmetric deal. In this example, her investors gain a passive return just by offering their stake as collateral. And so I like that idea of having it be an opt-in service, or maybe something kind of like an industry standard for a reserve ratio to prevent the lenders from over-leveraging, as it does seem to be a natural incentive as they seem to increase profits. So that's kind of the one thing that I might bring back or make sure that we tether a little bit. Collateralized lending itself is an amazing concept, though, and it's such a great opportunity for investors around the world to earn a passive income on their current assets, whether, as we've talked about, it's cash and equivalents or even ownership in equities, debt, or hard assets. I think it's a strong business model for the lending facilitator as well to capitalize on the outstanding float of assets currently custodied. And with a larger lending pool, smaller debtors are more likely to receive funds at a manageable rate, which is good for the economy and for small businesses. The only other feeling that I have is a strong one against the idea of under-collateralized loans. As we really begin to stress test this technology and evaluate the viability and feasibility of fully on-chain lending, peer-to-peer collateralized lending on a massive scale has a very slim margin for error, as the default risk can collapse the entire system. And so this risk increases tremendously if the lenders begin to stake fractional collateral to increase their lending portfolio. This puts investors' capital at risk and is something that I'm not a huge fan of, at least until we can get some sort of insurance on the staked capital, or again, at least until we can prove this concept on a massive scale. I think that we may be unfortunately biting off more than we can chew if we start to do fractionalized collateral and things like that. And we have seen some of those pop up in terms of some solutions, some just in theory, some using synthetic derivatives, which again, I just think is an interesting idea and something fun to discuss in theory. But until we can really prove the concept on a big scale in an MVP, minimum viable product sort of fashion, I do think that that's a little bit risky, and it's not quite something that I'm interested in covering a whole lot, to be honest.
I think that's completely fair to say, Kyle. I definitely worry about that too. I mean, per the term decentralized, any actor in the space will have a lot of freedom to try new models of finance out, of course, using smart contract technology. But as we saw in the previous financial crisis, lending to just about anyone and not requiring a lot of collateral from the borrower can be a recipe for disaster. So if DeFi doesn't want to get tainted with the same bad name as the ICO and crypto community had garnered from the regulators, I think they need to be very cognizant of doing things ethically and providing safe practices to prevent any future blowups on top of already hacks, right? So definitely food for thought. And with that, I think that's all the time we have on this topic. It concludes our show. So I want to thank you, listeners, of course, for tuning in once again. Always remember that you can give Kyle or I feedback via Twitter or LinkedIn directly, or engage with the community on stomarket.com. Catch you next week.